Chairman Lucas, Ranking Member Vargas, and members of the task force, thank you for the opportunity to testify. My name is Bill Nelson, and I am Chief Economist and Head of Research at the Bank Policy Institute. I previously served at the Federal Reserve Board working on monetary policy analysis, including balance sheet policy. The Federal Reserve's balance sheet matters because it shapes how monetary policy is implemented, how the Fed interacts with the financial system, and the risks ultimately borne by taxpayers. On the asset side, the Fed holds mainly Treasury securities and agency mortgage-backed securities. On the liability side, its largest item today is reserve balances, deposits of banks at the Fed, along with currency and the Treasury's general account. Because currency demand is set by the public and the Treasury controls its own account, the minimum size of the Fed's balance sheet is largely determined by banks' demand for reserve balances. Before the financial crisis, the Fed implemented policy in what is called a corridor system. In that system, the Fed only supplied the level of reserve balances that the banking system needed, and private interbank markets actively distributed liquidity and imposed discipline. The Fed had good interest rate control, even though its footprint in markets was tiny. After 2008, emergency lending, quantitative easing, and the authority to pay interest on reserves led the Fed to adopt a floor system in which a massive quantity of reserves pins money market rates to the floor created by the interest rate the Fed pays for reserves. In January 2019, the Fed formally chose to remain in that system. That decision has had serious consequences. First, the unsecured interbank market has withered. With an excess supply of reserves, banks no longer need to borrow from one another for liquidity management purposes. Second, an unconstrained balance sheet becomes an attractive source of funding for government initiatives. As FOMC participants warned at the time the Fed officially adopted a floor system, a large and unbounded balance sheet invites political pressure to use it. Third, the floor system may have encouraged complacency on the part of the Fed about interest rate risk. Quantitative easing transfers that risk from the private sector to the Fed and therefore to taxpayers. When short-term rates rose sharply in 2022 to 2023, that risk materialized in large Federal Reserve losses. Fourth, abundant reserves worsen discount window stigma. Borrowing becomes rare and signals distress, preventing banks, supervisors, and investors from viewing the window as a normal backstop. Finally, there is a ratchet in the demand for reserves. Reserve demand rises easily but falls only with difficulty because bankers and bank examiners grow accustomed to abundant and cheap reserve balances and make adjustments to make use of them. In 2008, the Fed estimated that a floor system required about $35 billion in reserves. Today, that figure is roughly $3 trillion. The Bank of England, the ECB, the Bank of Canada, and the Reserve Bank of Australia have recognized these costs and are shrinking their balance sheets and seeking to revive private markets. If the Fed wants to do the same, it needs to take 3 steps. First, move overnight market rates modestly above the interest rate paid on reserves, creating an incentive for banks to economize on reserve holdings. Second, avoid repo market volatility by conducting temporary open market operations to manage easily predictable variations in reserve supply and demand, such as occur on quarter ends and days with large settlements of Treasury securities. Third, reform liquidity regulations so that banks can count discount window borrowing capacity established with pre-positioned collateral as a source of liquidity. This single change would reduce reserve demand, make liquidity regulations more accurate, encourage discount window preparedness, and boost economic growth and employment. It would support growth by allowing banks to make loans to households and businesses, which they would then pledge to the Fed, rather than forcing them to fill up their balance sheets with reserve balances. In closing, turning a large institution is never easy, but the experience of other central banks shows that a smaller Fed, one that acts as a backstop rather than a market replacement, is both feasible and desirable. Thank you. I look forward to your questions.